European stocks crumble as food and energy price spikes increase recession risk. Euro melts down as central bank policies will likely diverge. And commodities go parabolic, including gold, which breaks 2,000. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is March the 8th, and let's take a look at these markets. So obviously, markets remain in turmoil since the invasion of Ukraine. Commodity markets remain the epicenter of all of the volatility though, right? We're getting 2 to 6 sigma moves across the board. And that's where vol's already quite high, right? To get a 6 sigma move in something that's a high vol asset, you're talking about ridiculous moves. You see, this is a good one from Macro Hive. Just kind of putting everything in the context of standard deviation moves rather than percentage moves. So, we saw European equity and bond markets feeling the contagion as market prices, as a potential recession was getting priced in. Given the higher food and energy prices, also the kind of humanitarian crisis with millions of refugees fleeing Ukraine is going to put further stress on the EU economy. So you had obviously DAX, EURUSD all getting killed, and European rates moving pretty dramatically, euro dollar moving pretty dramatically down towards that 108 level, which is a massive technical support level. You also had inflation break-evens in the US spiking higher as that commodity price shock is kind of expected to now last a bit longer, whereas we had hoped we had seen kind of the peak in the supply chain issues. This is a whole new ball game now, right? As the US is pondering like a Russian oil embargo and to turn up the heat on Putin and things like that. All manner of things can happen now, right? All bets are off, and the commodity markets are certainly, feeling the brunt of it. Okay, so that's kind of the wild moves we've been seeing. Now, if we look at what can happen next, right? So Michael Hartnett, the strategist at Bank of America, has put out a piece recently talking about how war is stagflationary. And he's drawing parallels from this current episode. He's drawing parallels to the Yom Kippur War and the oil shock of 1973. And he's saying in that episode, you had 2 years, 1973, 1974, where only commodities outperformed inflation, and the likes of the S&P were down like 40%. And so he's gone back, he's looked at, which sectors have outperformed, which sectors underperformed, and put it on this quite nice graphic. They've called it a stagflation quilt. For some reason, it looks like a quilt. But basically, you look here, you've got 1965 through to 1979. And what you've done is you've ranked all the various asset classes and sectors, right? So at the top, we've got the best performing things in that year. And then we've got at the bottom, the worst performing things, okay? So you can see in 1973, where you had inflation was the highest rank out of everything. You've got long-term government bonds, energy, pharma, and telecoms generally performing, better. We still had negative absolute returns in those equity sectors, but they outperformed. Whereas the things that really got killed were, the likes of consumer stocks, tech stocks, bank stocks, small caps, things like that. They really suffered the worst of it, basically. And then, you had the Fed initially tighten like they had to in the face of rampant inflation. And then the market only bottomed out after the Fed reversed course and took rates down from 14% to back to around 3%, basically. Now, we know rates aren't going anywhere near 14% this time round. I mean, arguably, the terminal rate is being priced closer to 2. So we'll see how far the Fed can go. But the point being is that the equity market is going to be under a lot of pressure if that's the world we're heading into, basically, right? And we're definitely starting to see a lot of asset classes pricing that in various ways, shapes and forms. Okay. Then if we look at another thing from Bank of America that's pretty useful is the flows. So looking at the weekly flows, what were they seeing? So we had the biggest outflow ever in European equities, right? I mean, that's a pretty big statement, right? So weekly flow data showed about $6.7 billion coming out of European equities. And that had been quite a consensus long. You know, markets generally had been thinking that Europe had locked down harder. We were going to come out of COVID. We were going to have a stronger growth impulse. The PMIs were kind of reflecting that we were seeing. We're starting to see the right sort of trend there. People were looking for European assets to do quite well relative to the US. So the whole street was consensus bullish on Europe. And then all of a sudden, this wild card happens, taking markets down and people, you know, rushing to get the hell out of there, anything that might have exposure to what's going on in Russia, Ukraine. So, you know, really, really significant outflow there in Europe. Also seeing big outflows out of EM debt, financials. Financials, again, had been a bit of a, you know, loved sector, thinking yields are going higher, things like that. It's going to be good for banks. You know, a massive flush out of there, especially in Europe. European banks completely destroyed in the last couple of weeks. Yeah. And then the largest inflows were coming obviously into energy and materials. Materials had its largest inflow ever again, right? So looking at this data and going back as far back as these guys look, they're seeing ridiculous moves, not only in the price of assets, but in terms of the flows that they're seeing in and out of stuff. Okay. And given what's going on and that outflow out of Europe, you've got to think US exceptionalism, which we thought maybe we'd get a break from, given that the tech sector was a bit unloved. That may well be firmly back on the table as US assets regain some safety bid, at least on a relative basis, right? So that you need to kind of be aware of that. Obviously, the dollar's catching a bit of a bid as well on the back of that sort of stuff. Okay, so that's what we're seeing in flows. We're also seeing hedge funds degrossing, right, as you'd expect, right? So these type of, you know, as volatility increases, you know, it's very natural for the professional investors to take down books. So you've got the long short funds taking down their beta, taking down their gross as well to lowest levels we've seen since sort of last summer. Okay, that's the little chart there on the left. Now, what we're seeing in response to that is retail keeps buying, right? So, you know, whereas the S&P had a bit of a tough day yesterday, overall last week, the S&P kind of flatlined. And, you know, we're seeing retail flows in equities still there. So these kind of dark bars represent cash equity flows and the blue represent option deltas, right? So throughout, you know, Q4 last year, we had buying of both cash equity and call options. A lot of that premium ended up being wasted. So then we saw, you know, a bit of put option buying. You can see negative deltas there in terms of the option delta, but still buying the cash equity. And even in the most recent week, we saw a decent amount of buying from retail. Okay. So retail still believes in buying this dip. Okay. Historically, when the so-called smart money is offloading risk to retail historically has been that last buyer who doesn't get the memo until at the end and then the market crashes. Now, I would say that was usually the case. The COVID sell-off was a little bit different. There was a lot of retail participation and buying in the COVID crash, and retail killed it on that. And that's kind of the first time that they ever really did, you know, do the opposite of what the real money was doing and kind of win that battle. This time round, not so sure, right? That their faith in this market and in the Fed being able to help out and buying the dip doesn't really seem as smart this time around, right? So I'd be a bit sort of wary of that, and the flows that we're seeing there, basically, right? I think they may well be quite disappointed that this dip, whilst we might get a little bit of a pop, it may well be quite short-lived. Yeah. All right. If we then go to looking at the price action of the S&P, so you know, all last week, we're kind of bouncing around pretty violently in a range of around about 120, 150 points in the S&P. So this kind of resistance band that I've drawn up here was kind of spot gamma's call wall area, 4,400 to 4,450. That kind of acted as pretty formidable resistance, couldn't really break through it. Briefly kind of got up there once and then failed. On the downside, we kind of tested 42.80 multiple times last week. And it did feel, as I kind of posted on Twitter, that it was looking more and more fragile. The fact that we just kept retesting this level and we couldn't really bounce significantly off it. You see, we're making lower and lower highs there. And then after the weekend, we did see that downside break, and we kind of really overshot down to kind of the next key levels, right? So I had 42.25 on there as a level, had 41.20 as well. We broke that yesterday. Didn't quite get to 41.20, got down to 41.40 overnight, and we've kind of bounced there. But was expecting some short-term support, at least at that level at 41.20, basically. Below that, 40.50 is the next target area, basically, right? But, these things are very volatile. So we're bouncing around quite violently along these levels. Fear and greed index is in extreme fear. So clearly the markets are very oversold. So even though this sell-off has been relatively orderly in S&P and it hasn't at all been in Europe, right? So we can look at European markets on a relative basis here. You can see, if we go back to end of February, start of March, we've got Europe down, 10, 12%. We've got S&P kind of unched, right? So that's from, well, you can see, right, we had EM and Europe has been destroyed on a relative basis, right, underperforming by, order of magnitude 10%. A proper flush out was yet to be seen in S&P. Now, you could argue yesterday's move may have been that flush out. Personally, I still think there may be some room to go. And, markets tend to crash from oversold levels, not from overbought levels. Okay, so we still need to tread carefully, because the kind of the crescendo of this correction may still be over the next week or two, because I don't personally think the news flow is suddenly going to get a lot better. Okay, so let's just be very careful about what we're doing here. So that's kind of price action in S&P. Now, if we then look over to the vol positioning side of things, right? Still no real change in terms of gamma positioning. Street clearly still in short gamma territory. We are actually, according to spot gamma, we're below the put wall, right? Typically, when we're below the put wall, you'd expect to see some kind of profit taking come in, right? But the thing about this sell-off that's kind of different to previous sell-offs is it's not just like okay, we're thinking the market was frothy, we needed a pullback, we needed a correction, and then we can, keep on with the trend. We've got some pretty game-changing things happening in the world here. And so even if you are loaded up on puts to protect yourself, are you rushing to monetize them down here at 4,200 when we're staring at the world we're staring at? I'm not so sure. So we may have a situation where you can trade below that put wall for a significant period of time, which is not typical, okay? So that's where we are in terms of option positioning. And then, if you are going to get a bounce, you need volatility to come down, right? And the VIX, whilst it is arguably elevated, you compare it to a few other metrics, and I've kind of obviously flagged this yesterday. You look at things like the MOVE index, which is interest rate vol, miles above where it would typically be. Suggesting that the VIX hasn't really spiked anywhere near as much as that. You look at the V2X, which is the European equivalent of VIX, that has gone nuts. It's gone up to like nearly 60, which is trading at a 20, 25 vol premium to VIX, which is kind of unheard of in terms of the spread. So, these type of measures suggest that VIX may have still a bit more room to go, right? Clearly, there's been a bit of a move back towards US equities on a relative basis as people get the hell out of Dodge in Europe. But if we continue to see bad news and, the Fed continues on the hiking path that we think it will, maybe, the place where people are camped out in the US is the place where we see some stress, right? And the VIX could even, overshoot to 50 kind of levels before this is done, right? Obviously, you guys, subscribers will know I've kind of used that premium of V stocks to VIX to enter into a strangle swap, because I do think on the way down, the S&P is going to now participate in the downside. So I'm long some strangles, 91.10 roughly strangles on S&P, and I've sold them the 81.20 for the same price on EURUSD, which I think gives me a reasonable shot at making some money in either direction, basically. All right. So that's what I've done there. If the VIX was to come down, unlikely to come down before FOMC, but in a post FOMC, and if we get a sniff of ceasefire or even hopes of ceasefire, we know this market has a quick 100-point upside and vol comes down. That maybe gives the Vanna fuel and creates a bit of delta hedging need that drives the market back towards that 4,400 area, basically, right? Maybe that's what we get. But things are likely to remain pretty choppy if we stay below that vol trigger at 43.25, which it currently is, basically. All right. Now if we look over to FX and bonds. So massive breakdown in the euro. It's kind of the main story here. As I said, got down to 108, touched around 108 yesterday. European economy pricing in recession risk due to the commodity and prices and what's going on there. Now, whilst we may get a bounce from these oversold levels, so we've got, dollars looking pretty overbought here, euros looking oversold. But if we zoom out a bit in terms of euro and see where we could go, right? If we break this support zone, and I've highlighted this support zone, long-term support zone, 103 to 108, basically, right? If we break below that level, then that really opens up on a long-term basis a 0.85 type levels, basically below parity, right? So, this long-term trend in euro is very much, downtrend is very much intact. And that kind of needs to be closely watched, that support zone, over the next coming months, I would say. Okay. Now, there was some news out this morning on a potential joint bond sale from the EU states to raise money for defense spending and energy infrastructure to that reliance on Russia just needs to be addressed clearly, right? So if they start issuing a load of bonds to raise money for that we're apparently going to hear that more about that towards the end of this week. But the market kind of took that relatively well. European stocks had a bit of a bounce, and euro also had a bit of a bounce, and bond markets in Europe sold off. So the Bund, I think the Bund moved around 10 basis points, yield going higher, basically, right? So something to watch there, as Europe definitely needs to kind of get their act together and address some of these problems, basically, right? Longer term, is it going to be so great for the euro if they do that? Remains to be seen. Obviously, the knee-jerk reaction was euro positive, but I don't know. I'm still a bit skeptical that even if they do that, is that going to make euro rally significantly? So what's going on in commodities? Another day, another commodity up 50%. Right, it's pretty much what I'm saying. If we look at, we know the kind of the ones that are really going nuts recently have been wheat and gas. Clearly, supply concerns out of Russia. But now nickel's joined the party, moves absolutely parabolic. And basically what's been going on is you've got all these producers who have been using futures to hedge their production, right? But the problem is that production is on a time lag or is on, needs to be actually physically delivered and moved around, right? And these sanctions on Russia have screwed up that whole delivery cycle and whether or not the physical commodity can get to where it needs to be. So what's been happening then is the futures prices have just been spiking, and the margin calls on those future short positions have just been carrying people out, right? So you had China Construction Bank Corp apparently was the big issue in nickel yesterday. They missed the margin call. We're talking about hundreds of millions. Apparently they're down 12 billion or something mark to market. And nickel basically has been suspended on the LME, right? And it touched over 100,000 per ton, right? Which was basically a quadrupling of price, right, in 2 days, right, which is just absurd. If we look at the BCOM index, Bloomberg Commodity Index had its biggest weekly gain ever last week. Looks like it's going to be even higher this week. And then you had this kind of BCO MIN, which is the metal sub-index to it, has got an RSI of 95.72. Highest ever reading on the RSI there, okay? And that was before today's move in nickel. Today's move in nickel has like blown that through the roof as well. But just we're seeing insane levels. The prices are just completely dislocated from reality. and they're clearly going to come back down at some point. But because of the problems we've got with regards to sanctions and moving this stuff around, God knows when this is going to end. Now, I've owned some nickel since last March when it had that drop in my long-term pension. Obviously, it's up 300%. So I've been offloading it, basically. I've still got a little bit left, and I've been crossing ridiculous bid-offer spreads to just offload some. But I'm of the opinion that once this margin issue is done, prices will likely drop quite dramatically, and you'd be a fool not to take some chips off the table when you've made so much money on. It's not like I was long nickel anticipating this type of move in this short space of time. If I'd managed to achieve this type of move out of my long-term nickel position over the course of 2 years, I would have been very happy. So I'd be mad not to de-risk that in this type of move, even if it's a long-term pension position, basically. I'm going to still keep a little scrap of it because I believe in the theme longer term, but clearly same thing with crypto, right? When crypto had its crazy moves last year, again, if you're holding some of that stuff, you're mad not to participate and let some of it go and take some profit, in my opinion. And that's basically what I've been doing. Okay. All right. And then what else in commodities? Obviously, gold is another big one, right? I was mentioning last week that gold was not doing what it should have done and wasn't really moving in line with other commodities as you would have expected. And I was blaming that on Russia likely, liquidating some of their reserves in an attempt to prop up the ruble. And I also tweeted a chart with the ruble superimposed on the gold price, and they were moving and tracking each other very closely. Okay. That hasn't really been the case in the last sort of 24, 48 hours. That they've kind of started to decouple a little bit. And also the gold price has kind of now gone through key level at 1960 and even breached 2000. Okay. So you've got the chart here on gold. If it can break the highs that it made last, in the summer 2020, which was 2075, if it can break that, then we're looking at potentially a lot higher levels from a chart perspective. Goldman's have also revised their targets up in gold. They're seeing, the major gold demand component impulses that they're calling. God knows what their terminology is, but basically they're saying you've got consumer demand, central bank demand, and ETFs. And they're seeing the impulse in all of those drivers to be significantly higher this year. And when that happens, that they're expecting a decent rally in gold. So they've revised their 6-month price target on gold up to 2,500, right? Which from this level, we're looking at another 25% upside potentially. Okay. And, it makes sense, right? Like for me, the biggest reason why I think gold will rally is that obviously you've had real yields collapse, you've had geopolitical tensions that are still here and not going anywhere. But foreign central banks are realizing that dollar reserves that they hold could end up being a liability rather than an asset. If you look at what's happened with Russia, right? So that is in itself a motivation to switch some of those dollar reserves and fiat reserves into something hard like gold, basically, right? Because you might need it when the shit hits the fan. Okay. So I think that's a big reason why gold's rallying, and is also going to be a big reason why gold probably continues to rally longer term, right? Could it have a pullback from here? Of course it could, but it's certainly now starting to show signs of life. And we know when gold does start to work, it can trend for a while. And I think there's good reasons, structural reasons for that. Okay. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.